right, and welcome back to The Compass. We're recording this episode on Thursday, April 17th. I like to timestamp them because of the volatility we're seeing in the markets. With me, as always, is President, CEO, and Director of Chief Investment Officer of Olive Resource Capital, Sam Pelaez. And my name is Derek Macpherson, and I'm the Executive Chairman of Olive. Today, kind of quick, a little bit of summary from our last episode. Obviously, we talked about sort of the vol in the markets and what we thought that was going to mean, and then talk about kind of what we see coming. I think there's, it's one thing to know where we've been and what's moving, but it's the next thing to think how to position yourself for what's coming. So, Sam, we kind of, our conclusion from all the world didn't play out exactly as we expected, and we noted. I think we recorded that episode at 10 o'clock, and Trump pulled the tariffs at 1 that day. So but the inevitable thing is that what happened is gold went up, gold miners went up, and gold miners went up a lot. That was I guess a little over 7 days ago that we recorded that episode. One of our picks from their Anglo was up 20 something percent since that.
Well, it's up 20 something percent this month, but from the lows of the month is up. From the lows of the month to the highs of the month is about $20, and I guess if you count it that way, from the lows to the highs up about 80%. So the moves have been quite significant.
Yeah, and I think that's and we were talking about this just before we came on, but it feels like everything that has happened, right? You've got equities that are weak, right? That's been what's kept people out of the gold. General equities are weak. You've got bonds that are weak. The normal safe haven trade isn't happening, right? The bonds have been weak, and the dollar is weak, and so people are gravitating towards gold and gold miners. I saw a couple generalist talking heads talking about gold, right? Which normally is a bad side, but I think in this case it's the place that capital is gravitating towards the space, right? Whether it's the gold itself or to the gold miners that have sort of relatively been historically undervalued relative to the gold price.
And just to pick up where we left off last week, we were talking about volatility and what we thought maybe the bottom was in that day, or who knew when it was going to happen. So far, it was right, like you said, 3 hours after we recorded, but. Our conclusion was that gold was the place to be for the time being. And what's happened since is, breakout rally in gold. And the transition we've seen from last year where gold was outperforming gold stocks, and then gradually gold stocks had started outperforming earlier this year. And over the last week, and maybe a couple of months when you put it in a more broader context, is equities, especially producers, have started to outperform the commodity quite significantly. If you look at the charts of London Gold, London Precious Metals, K92, Kinross, you're seeing the beginning of the parabolic move that we always see. Let's not call it the later stages of the rally, but let's call it like the mature phase of the gold move, when the money starts rolling into the equities. And we're seeing it with the producers. And frankly, if you bought this equities 2 years ago or 10 years ago, you could be sitting on, in the case of Northern Star, you could be sitting on a 30x. In the case of Kinross, you could be sitting on a 7x return on your investment. So I think this is to say, we're clearly in a gold market. Obviously, the gold market is already here.
Well, I think the delta to sort of, even a couple of months ago, is that I wouldn't even say it's almost FOMO. Like the generalist market recognizes that there's a trade here, and so there's money flowing towards the space.
Right.
But I think also, in the context of all other asset places, people are going, well, I can't, I don't want to be in bonds. I don't want to be in, general equities. The Mag 7 are coming down. I don't want to buy the SPX, right? Or I don't want to buy the SP 500. So there's a chase there. And I think the economic uncertainty, that's participating in that. So, we've seen big moves in gold miners. And I think that's and for the most part, gold miners, right? We've seen some developers move. I know Troilus had a really good move off that sort of that bottom moment, which is named we own. There's a few others that have had decent moves, but not the same type of momentum and strength and money flow that you're seeing in the large cap names. Atypical of the cycle, and do see the large cap names move first. So I think that's not atypical of the cycle, typical of the cycle, right? And you see the large cap names move first. So I think that's, I think we're kind of, things are playing out as we expect. And I guess now the question becomes, what happens next, right? And this isn't what happens next as in next week. This is what happens next over the next, the next few months, right?
Yeah.
I think.
Sorry to interrupt. It's a lot easier to kind of figure out how the playbook works. The timing is incredibly uncertain, which is why you have to find the good stocks and just buy them and keep them in your portfolio. And please continue. Sorry for the interruption.
No, that's exactly right. We were talking about offline before we started. We were talking about that just to hammer that point home, right? It was what you say 14 years ago. You got when they first were financing London Gold. It was
2014, so it would have been call it 10 years ago.
Yeah,
2014 or 15, I can't remember. It was a $4 financing led by GMP.
Yeah.
And if you bought that, you're sitting on 15x return.
Right. And so I think kind of what it's really hard. It's really hard to buy stocks at the 52-week high. It's hard to get over the mental block to do that. I think it's between your ears. Even though I think that the gold space still has momentum from here, right? Because we haven't seen. I don't think that the market is going to price in a bottoming out in the general economy yet, and there's still recession fears, and so because that isn't going to get priced out, my view is, and Sam and you and I probably disagree on this a little bit, but we haven't quite seen the bottom yet in like things like copper, silver, which is more industrial than precious these days. And things like that. And so there's I think the momentum and the money flows are going to stay in gold for now until we have that, whether it's the Fed cutting rates or some other moment that kind of declares the bottom for the general economy and the general markets.
The money in the resource space is like it just slushes around from one commodity to the other, which creates opportunities to buy. But also when the momentum is behind you, number one, you can't sell because we're talking offline. Like in the Denver Gold Show last fall, London Gold hit $30 a share, and I was thinking, wow, that's an incredibly nice valuation. I'll be rolling this over into something else as a portfolio manager. Well, it's 50. I think we said $57 last I checked. It's nearly 100% return since September on obviously a very high quality name. So the momentum is clearly behind gold stocks. You can't get off the train because you never know where it ends. And I think we're starting to see that parabolic move that happens when the markets get hot. And it's obviously incredibly hard to tell when it ends or how it ends. But from a playbook perspective, what's happened historically and what any student of history would tell you is that the money will start to find its way down cap, which is something we've been talking about for the last 12 months, right? The equities were underperforming gold. Now they're outperforming. Now what's likely to happen is that the money is going to find its way down cap. Eventually, we hope to the developers, which is where we are well positioned.
Well, I think, the money historically moves down cap. You look at the last two significant cycles, sort of 2001 to 2005, 6, 7, in that range, and then 2009 to 2011. What you got is a big move in producers initially, gold price, then the producers, then the developers, then the microcaps, and it flowed all the way down, right? It flowed down to the point where you could raise $20 million for something with a interesting geophysical signature, which was, that's where you put the pin at the top, I think. From a really sort of rudimentary perspective, we expect gold stocks to keep running. We're not, by any stretch of the imagination, just because they're up at their 52 weeks highs, I don't think we're not sellers here, obviously. And I think that's I think that's an important point, right? Is that we're not and we're not really rotating down because we've sort of been well positioned on the gold side. We're well positioned across a few commodities, but I think we're well positioned on the gold side with some really good names, and I think that's good. And I think as we see the money flow down, so the interesting part is because of the M&A cycle that we've sort of already been going through with the gold price up and the equity's not moving. Typically what happens is the big guys move, so your Nikos, your Anglos, those companies move. Then you get down to the sort of the mid-tier producers, but all those have moved as well. And the mid-tier producers aren't, in previous cycles, the small producers were kind of 100 to 250,000 ounces a year. There aren't really that many companies that fit that category anymore. And so we're seeing those stocks, though those stocks are gone, or the few that are there have moved along with the large caps. And so the next natural progression is down to the developers. Now, obviously, we've talked about this. What is inevitably happening is you have generals coming in, they see stocks at 52-week highs, and they go, well, can I buy something else? And they move down to the developer. They start looking at developers. What also happens is you have resource funds start to roll. They start to make big gains on their large positions. And a lot of traditional resource funds have position limits. And so as soon as a stock gets too big, they have to sell off. Well, their natural thing is that they roll down cap. For a resource fund, I heard this best described. It's sort of the barbell approach. And the guys who get into the junior stocks first and get out of the junior stocks first are the ones who get the alpha. And so you're going to see a roll from more traditional resource funds looking down cap. And we've actually seen that sort of out loud already, right? You saw it was announced, so it was very, very well publicly disclosed, but the Van Eck Van Eck buying that Troilus position in a one-off financing, right? Van Eck's one of the largest resource funds in the world, both from a ETF side and a traditional.
It's that one is very telling and interesting because obviously these funds don't have this is obviously an early investment because naturally at this stage Troilus didn't have the liquidity for a fund like that to build a position, right? So they have to call the company and say, hey, I want to be invested. And that's typically a sign that they're early, right? When they have to do the one-off financing. Same with some issuers do the same thing. We've seen it in a few. Hotbay with Arizona Sonora. No, that's not gold, but I think it fits sort of the same purposes. I want to have a block that I can't buy in the market. And like you said, those are early in, and those are the guys who get the alpha. For us, smaller investors and retail investors, fortunately, we don't have those liquidity issues. But these are very good signs that you're positioned, you're well positioned for the next leg of the market.
Right. So yeah, and I think what you're going to actually see, this is I think this is the kind of the point. What we're going to see obviously is we're going to start to see some smaller companies start to move. So if your favorite small company hasn't moved yet, now's the time to buy it. Or if it's moved a little bit, don't be afraid to buy. I think don't let your bias of feeling like you missed it get there, because these things are going to the gap between developers and producers is going to close materially.
And I think you brought this point in private conversations, which is we're at the sweet spot for the bankers and the salespeople to start offering money to these companies because they've outperformed over the last 6 weeks. The developers have moved nicely. But there's still a sweet spot where you can raise significant amount of money, set them up for the next 12, 24 months, and still lots of upside left for the new incoming investors.
That's a really good point. Investment banks typically chase momentum. Because that's where they're there to make fees, and so when a commodity or sector is hot, it's there. You raise money for those companies, right? Because you have investors that you have demand from investors for that commodity type of those companies. And so we are going to see if your favorite junior mining company needs money in the next 6 months, there is a good chance that it will raise money in May or June this year, in the next 6 to 8 weeks. So it's something to be very cognizant of and aware of. It might not be at the current price, right? They might have news flow or something that happens that all of a sudden what the stock you were trying to buy at 35, 40 cents, it goes to 60 and they raise at 55. So don't wait for that. Don't always be, when you're in a hot market, waiting for that financing can be a bit of a can catch you off guard, right? Because the stocks start to move.
Yeah, and in some cases, the financing is the overhang. So maybe the stock is 40 cents, like you said, goes to 60, and they raise at 50, and you're happier to buy it at 50 than at 40, just because you know the overhang is gone.
Yeah. Well, the other thing to keep in mind is that, unlike a lot of with this move coming, there are companies that have money and news flow, right? So there's a balance there. But I think also, to fill in that point, or maybe on the backside, and to what you just said, the financings can act like a catalyst, and in this type of market, because all of a sudden that company that you thought was dead or wasn't really, the last two financings were to keep the lights on and maybe do a little bit of work. A lot of these companies, if they have good management teams who have been keeping these companies together, what they've done over the last 2 to 3 years, these smaller explorers especially, is they went and did the cheap work, whether it was surface sampling or geophysics or channel sampling or trenching or whatever, because drilling was the thing they couldn't afford. And so they got targets, and they're gonna raise money and drill their best targets. And so what happens is that all of a sudden a company that you thought was sort of inactive and not producing good news flow, they get momentum, because all of a sudden it's like, oh, they raised $5 million, they're going to go drill at this project in wherever, and they have these really good targets because they've spent all this time in science. They've done all the science to make them the best targets possible.
I don't want to say for the first time, but we're starting to see a more broader appeal for the explorers. Southern Cross, which is a company that we like, has done fairly well. The CNL, the collective mining, has done exceptionally well.
And that's a good example where you've got a major invested, right? The last financing collective did was Agnico Eagle. Was led by Agnico, right?
But yeah, you're starting to see that broader appeal for the exploration companies that was completely absent. Maybe not completely. I'm exaggerating, but it was very far and few in between over the last couple of years. Now we're starting to see a few more of them with sizable valuations. Collective is over $1 billion now.
And I think that's that function of the money flow, right? You're seeing money flow down cap, and it still is. It's not, we aren't at the ninth inning of it where, like I said, you have gold in the name and you have an interesting geophysical anomaly that you can raise you can raise $20 million on. We're not at that part of the cycle, but we're definitely at the part of the cycle where, if you've got companies have good results, they have good projects, they're moving them ahead, they're going to be able to get capital. And so I think that's something that, you as an investor, you need to be, I guess as an investor, we're very cognizant of, right? That are we going to get cut off by financing? But B, is this company going to go out and raise money, and all of a sudden that transforms that company, right? It's a bit of a balance, right? Because sometimes you worry about financings can kill momentum, right? So if you've got a stock that's really running, and let's say stock goes from 25 cents to 70 cents, right? Because it's got some good results, things are moving, and then all of a sudden they do a financing back at 50, right? Because discount rules actually can almost let you do that, right? You do this big steep discount to get a financing across the line. Well, if you bought it at 65, you're pissed, right? Because you're watching this thing and it often kills momentum too, right? So that stock takes time to recover back to those levels. On the flip side, if you've got a stock that maybe has good results and is a little bit stagnant, doesn't quite have the market, because there's still that opportunity here. And maybe it's a structural thing. Maybe it's there's a financing overhang or a warrant overhang or something else that is holding it back. But they need money, right? And then that's what's holding it back.
But I think so. I think we're walking into this space. You're correct that we may see a lot of financings over the next 60 days, but because a lot of people are moving down cap, those financings are going to be predominantly funded by new investors into the stories. So you don't see that rotation of capital, because what you see a lot of times is people selling on the market to buy in the placement so they can clip the warrant in the exercise. when you have this, larger institutional funds that want to be involved in stories that they typically can't buy on the market through a financing. So you get a $10 million financing with 6 or 8 million allocated to 4 or 5 big institutions. Those typically trade very well after the financing, because they mop up all the kind of like momentum and available liquidity into the financing and remove the overhang. And I suspect those are, we're going to see all kinds of financings, but I suspect the good stories are going to be funded that way in the next 60 days. So the financing could actually be, like you said, a positive catalyst to move the stock to the next level. We've seen that with a few already, right? A few stories that have traded very well after the financing of the last 6 months.
Yeah, well, example of that in our portfolio would be like First Nordic, right? That's done really well post financing. I think, but I think, one of the things that investors look at it, and this is a thing that kind of always, it's a bit of it's something that always bothers me is people look at equity financing as dilutive. Well, equity financing's on a per share basis, yes. You are, as an investor, you are being diluted. If you're working with if it's a good company, generally they'll try and provide for investors to come in, right? For existing shareholders to come in. So you have an opportunity to participate. Now, you don't always have liquidity to participate, but you have the opportunity. However, as a company, if your company is, if you're a $50 million market cap company, you're raising $10 million. The assumption is, and so now your market cap is 60, right? Because post dilution. The assumption is that you're going to create more than $10 million of value with that money. If you're not going to create more than $10 million of value, then you probably shouldn't be doing it. They're breaking poor capital allocation decision. But if you're going to create more than $10 million of value, that financing becomes less dilutive, right? And if you create $20 million of value for that $10 million of financing, it's almost non-dilutive, or the dilution is very minor. And I think that is, in this, in a hard market, when markets are really hard, it's hard to create that value, right? When you can't go out and drill, your decent drill holes don't get rewarded. And so it's hard. In this market, with this kind of momentum behind it, you can create a lot of value for not a lot of money here. And I think that's a really, really key point in this part of the cycle that, as a shareholder, don't be afraid of your company raising money. And frankly, to the management teams out there, don't be afraid of raising money. Don't wait for September or until your treasury is even lower. If you're when banker XYZ shows up with a check, this is the time to take it because the momentum's there and the money's there.
Yeah, no, you know well how it works, having been on that side of the bench. There are windows where you can finance different types of stories, and there are a lot of windows or a lot of moments where you can't. So if you're an issuer, you always want to raise money higher. It's the natural exercise, but you have to ponder what the timing is, and I think this is a pretty good time, frankly.
Inevitably, every time that I've when I was on the sell side, every time that we would put an opportunity to raise money in front of a company, and then they turned it down, we would inevitably be doing that same financing, but at a lower price, which, if from a dilution perspective, and you put your shareholder hat back on, is actually more dilutive. Shareholders don't see that, right? They don't see that those conversations that are happening. Could have raised money at 25 cents and you raised it at 10, right? Because then you got to the point where you had to raise, and the market knows the market. For all the people who think that the market, there are value dislocations and things in the market that create opportunity, but the market is pretty smart. It knows when you need money every time.
Yeah, we always hear about the 1 in 100 stories where, I turned down the money and then this happened and I raised the money twice as high. But that's 1 in 100. The other 99 who turned down the money had to take the money later at a sizable, in most cases, sizable discount to what the bankers offered them in the previous round. So yeah.
I know this is good. This sounds counterintuitive but money taking companies that your favorite company taking money in this environment is a good thing, not a bad thing. Because they can build a war chest, they can do a lot of damage. It's really important, especially for exploration companies, to be funded one drill program ahead. Really important. because there's always news flow coming, and so it's harder for people to justify selling.
Yeah,
And you know,
you can't box them into a corner with the financing, right?
but
If you spend all your funding in one drill program, you have the results in hand. You walk into the banker's office and they put you into the corner because there's nowhere else you can go. You need to walk out with the check, right? When you have the next program funded, you have a lot of leverage and maneuvering that you can do to buy time or flexibility or pricing, really, when it comes to raising the money.
you can choose what you raise. I guess the other, I guess for us, I guess for how we look at things, the other thing that's actually good about this type of market, though, with equity dollars coming down, Cap, is that some of the more creative forms of financing that are all dilutive. Nothing drives me nuts more than people
Non-dilutive financing on the
the
headline.
comment. The only non-dilutive financing out there is a government grant. Everything else, and which is kind of dilutive because you pay taxes for that to exist. But every other form of financing is dilutive, whether it's debt or a convert or a royalty. They're all dilutive. They reduce the a shareholder's ownership of the asset or the future cash flows. And some of them they sound wonderful at 2% NSR, but if you think about it on a project basis, a 2%, I figure this out. 2% NSR is like a 10% project interest, right? If you think about it, except without having to without having the capital calls. So, which you don't have to fund it. They don't have to fund their interest, and so I think that there is so that is by definition that is dilutive. So I think that it's actually more dilutive than you think it is. But I think that that's a really important point for people. Like, if your favorite company comes out, if I see a company come out now with a royalty financing, right? And I'm not saying at the construction stage, because construction stage is different. I think that's a thing. But if your favorite Explorco or developer comes out with a royalty financing now, I don't know.
Well, I guess it depends. It depends on how much money they're bringing in, right? Because, like you said, every form of financing is diluted, right? So you're giving a 2% NSR. What are you bringing to the table? If it's not a sizable check, then it's extremely dilutive, right? And it also, remember, like when you do project finance, you need all the gavels and levels that you can pull. If you already burned your royalty opportunity, if you already have a 2 or 3% NSR of the project, by the time you get to project financing, you have no more royalty capital available because you can't settle a project with an extra 2% to bring it to 5%. We've seen that before. It typically kills the host, as they say, right? Like when you saddle the project with too much royalty, it just kills it. So
yeah, well, that was classically what happened in the early days of Sandstorm, right? The early days of Sandstorm, and they had pretty aggressive streams, and they killed projects with that. And then, yeah, I think they've obviously smartened up since then and altered their model to be a little less parasitic, but as a host. But anyway, I think rolling back the conclusion, right? Like if your favorite Explorco does a royalty financing right now, there's capital out there, there's equity capital out there, and while they may believe their project is wonderful, and every CEO should, now's the moment to take equity. And so I think that's going to be and I think that is going to be it's going to be good. We're going to have money in the space, which means we're going to find things. And once we have money in the space, we start finding things, stocks go up. We're cognizant of the time here, Sam.
Yeah, I just want to say one thing to wrap it up is this is a very exciting time. If you're invested, your investments are doing well. There's a lot of, I'm certain a lot of things are happening behind the scenes between bankers and issuers and M&A and capital and financings coming up. It's a pretty exciting time to be in this market. And, we've sat for years and years downtown Toronto to complain about the state of the market. Well, it's finally here. This is it. Don't blink. Don't miss it. This is it. Like the next couple of months are going to be tremendously important for this market, and you better be around and paying attention.
It's, like I said, it's yeah, that's exactly it. It's not too late to buy. That's the yet because it's gonna go. It's still got room to go. So I'm looking forward to it. I think it's you and I unfortunately both started towards the top of on the downside of the last market, right? So
it was a very long ski hill then.
Yeah,
8 years.
After a very long ski hill up, and so I think that we have the opportunity, and I think what we're once we see some economic certainty or a bottom on the economic uncertainty, I think you're going to see other commodities will catch a bit, but until then, gold's the place to be.
Agreed.
All right, thank you very much, and look forward to speaking to you all again shortly.